from this one, what I see is that the biggest move in precious metals is yet to come. It's just started. Now, again, this is a logarithmic graph. And so percent change. And if you think the rise from the year 2000 to 2011 was breathtaking, then you haven't seen anything yet. The rise that we've had over the past year and a half is just the beginning of something absolutely enormous. And so if you do think that there's the possibility of a monetary reset, you may want to be rethinking, is gold overvalued or not? Because the only conclusion I come up with is no. It's still the dollar that's overvalued.
Over the past 18 months, U.S. Treasury yields have mostly ranged between 3.5% and 5.0%, while gold has surged from around $2,000 per ounce to approximately $3,400. One of the major drivers of this sustained rally has been steady central bank demand, particularly from emerging markets, where institutions are increasingly favoring gold over traditional reserve assets. This structural trend is expected to persist through the remainder of 2025, continuing to provide a strong floor for gold prices. MikeMaloney, founder of goldsilver.com, believes this rally is just the beginning. According to him, if the U.S. economy tips into a recession or financial crisis, the Federal Reserve is likely to return to its familiar toolkit, slashing interest rates and expanding the money supply through aggressive monetary easing. That scenario would further fuel gold's ascent. Although recession fears have moderated this year, prediction market data from Kalshi shows that the odds of a U.S. recession in 2025 have ticked up slightly to 21% from 19% earlier in the week. While that's still near January's low of 17%, risks remain elevated given geopolitical tensions and fiscal instability. Goldman Sachs has adjusted its outlook on interest rate cuts, citing early signs that the inflationary impact of tariffs is smaller than expected. However, other disinflationary forces are giving the Fed more flexibility to ease policy if needed. JP Morgan's Natasha Kaneva emphasized that recession risks and global trade uncertainty strengthen the case for gold hitting $4,000. Maloney argues that with mounting fiscal pressures, a dovish pivot by the Fed could ignite a new, powerful phase in the gold and silver bull market, one that may even surpass the explosive rally seen between 2000 and 2011. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I'd like to point something out, too. If you look after August 15th, 1971, when the first big peak there, and then it drops down, and we get let me see what was happening. That was the gold rising, and then gold fell and created. So we're looking at gold basically upside down here. So gold was going up in price, causing the line to fall, and then gold peaked in the last day of 74, and then from the first day of 1975 until I believe August of 76, gold fell by half. It had gotten up to $200, and it fell down to 103 in August or September of 1976. And so that causes that peak. Then it went all the way down to the bottom of that trough, January 1980. And then it goes up again, and it's not gold going up. This is gold falling. And then gold does a dead cat bounce and rises again and then falls. And you have an inverse head and shoulders pattern. And if you drew a neckline, which is a trend line, a neckline across those two peaks, you flip it upside down, and it's predicting a move going rising. And it way exceeded that. Now, that was predicting that gold would fall and the dollar would rise. Now, take a look at what we've got going on today. We have another slanted, not inverse, but a normal right side up head and shoulders pattern. And we've just broken the neckline. That trend line that you're drawing isn't just a trend line. It's a neckline on a tilted head and shoulders, which is predicting that this is once again a linear graph. And so if this was logarithmic, what it would be predicting probably is a return to the balance, the type of balance that we had back before 1960. What would be the average before 1960? About 7, 8, 6?
7-ish.
Right. Right. Do you see that? There's a right side up, head and shoulders in this chart. Yeah,
Yeah.
exactly. And so there's a lot of different ways of looking at this from a technical perspective. You can say, yes, it's broken a trend line. And that would mean that either it's overvalued and you should get out of gold, or you should accumulate as much as possible because it's going to make this enormous move coming up right away because it just broke this head and shoulders. Okay, this is a great way of sort of throwing in a confirming indicator. Do you believe that you should get out of gold, that the dollar is going to outperform it? If the dollar does outperform it, we should have a great economy. Stock market will just continue on up into a bubble. Now, there are so many ways of measuring the stock market, and there isn't one of them that you can find that doesn't say that it's in a gigantic bubble. And it's only PE ratios that show it being less than the greatest bubble in stock market history globally. There is no bigger bubble than what we've got going on, except when you measure it with PE ratios. Then it's like the second largest bubble in history that it's been in. But so there is a trend line. And if it's true that the trend line is the signal that suddenly one asset class is overvalued against another, or the currency undervalued against gold being overvalued because gold hit the trend line. Well, gold hit the trend line here against stocks. From this one, what I see is that the biggest move in precious metals is yet to come. It's just started. Now, again, this is a logarithmic graph, and so percent change. And if you think the rise from the year 2000 to 2011 was breathtaking, then you haven't seen anything yet. The rise that we've had over the past year and a half is just the beginning of something absolutely enormous. And so if you do think that there's the possibility of a monetary reset, you may want to be rethinking, is gold overvalued or not? Because the only conclusion I come up with is no. It's still the dollar that's overvalued. And do you think that there's a possibility that we could go into a recession right now? If you do, then they are going to be, if the Fed senses anything wrong in the economy, they've shown their hand. There's only two things that they can do: light up the printing presses and drop interest rates to zero to influence the banks to light up their printing presses. Actually, I don't know what you would call a number duplicating machine. It's just a computer. You're typing in numbers. Bank credit.
The M2 money supply, which encompasses all cash and readily accessible liquid assets, provides insight into the overall liquidity circulating within the economy. When measured against the price of gold, it provides a valuable macroeconomic perspective, essentially showing how cheap or expensive gold is relative to the volume of currency in circulations. Historically, this ratio has served as a leading indicator for significant shifts in the gold market. MikeMaloney notes that when viewed through a long-term monetary lens, especially about the vast amount of currency in circulation, gold doesn't appear overvalued. The current levels may indicate that gold remains significantly undervalued, potentially signaling the early phase of a much larger upward trend. Over the past 5 decades, gold has delivered exponential returns, closely tied to the parabolic growth of global money supply. And given the ongoing need for central banks to manage debt burdens and economic shocks through monetary expansion, there's little reason to believe this trend will reverse anytime soon. Analysts often prioritize U.S. data when examining this relationship for 2 main reasons. The U.S. dollar remains the world's dominant reserve currency, and gold is predominantly priced in dollars across global markets. However, the correlation between the money supply and gold extends beyond the U.S. According to the World Gold Council, gold has reliably mirrored the growth of the global money supply over the last 50 years. It has even outperformed traditional safe assets, such as Treasury bills. Let's get back to the interview.
I've thought about it many times, and I have made videos on it in the past, not for a number of years now. It is one of the indicators that I use for myself, and I was going to do some back testing on that combined with other indicators for our Insiders program. for a sell signal. I think it might be in my first book, but I can't remember here. But if somebody believes that they're going to stop printing currency and that gold has peaked, they should sell their gold and they should move into dollars.
There you go.
So one of the ways to see whether or not this has peaked compared to the currency supply is to measure it against other indicators to see if it's peaked against those indicators as well. You used 850. The one from Incrementum is monthly data, right? Yeah. Yes. So this is where we plugged in daily data in January of 1980 when gold peaked, but it's the daily close. It's not 873, the intraday. It's 850. So, okay.
Exactly.
And that shows that we are right on the trend line right now. And, if you think that this is going to determine if you think then that gold is overvalued compared to the size of the currency supply, then you really should be selling your gold and moving into US dollars. And here, what you see in 1980 is that one of the things that log does for us is every inch on this graph, or every, whatever measurement you're going to take, half inch if you're looking on your cell phone, quarter inch, or on a big computer screen, 2 inches, there's that big difference. If you've got to look absolutely vertically from the peak in 1980 to the distance to the green line, and then take a look at the difference in the distance in them today at the end of the graph. Tiny by comparison, minuscule. So gold is nowhere near as overvalued. According to the chart, they are actually very close now. The size of the bubble that gold went into, the percentage of global financial assets that it was in 1980 is very, very different. Today, nobody really owns gold. It's not a huge percentage of financial assets. It's very small. And so I know we're not comparing it to financial assets right now. We're comparing it to the units of currency that exist. But what this shows you is that because the others were drawn in a linear scale instead of logarithmic, where you're not seeing the percent change, you're seeing the amount change. That sort of fools us a little bit. Here, you're seeing the actual percentage change. So every inch on this graph is the same percentage change as the previous inch, where on a linear graph, it's not. I think they're busy replenishing those resources right now that would account for all of the gold flows that we have seen. They're ending, these central bank leases have terms on them. They've got to end these contracts so that the gold is not rehypothecated. It'll be very interesting to see when an audit finally does happen, and if we are headed toward any type of gold standard, anything related to gold, because the world's central banks, especially in the Eastern Hemisphere, they are collecting gold at a frantic rate. And it shows that the world's central banks think that something is up. And so we may be headed toward, and the fact that gold just overtook the euro as the second largest central bank reserve. And this just says to me that we could be headed toward something where gold is involved in the future when this monetary reset happens, that there is a transition coming, and it's natural. And we've had, we had one after in 1921 or 22, where the world went on a transition after World War I, different monetary system. Then it broke down at the end of the 30s, and after World War II, different monetary system. And then 1971, different monetary system. And they're very different monetary systems. The other ones they didn't affect the common man. They've affected any international businesses, and they affected countries and banks. The average person didn't even know they were happening. But when it comes to this transition, the other ones were little baby steps off of gold. This one is going to be one huge step back onto something real, something that all of the different countries can trust each other with, something that can't be created out of thin air. And if that happens, it's an enormous step that everybody on the planet will feel.
Unlike typical market cycles driven by sentiment or speculation, the current rise in gold appears deeply rooted in long-term monetary distortions. As liquidity increases and sovereign debt rises, investors are increasingly drawn to assets that possess intrinsic scarcity. When measured against the massive pool of circulating currency, gold's current price still looks modest, especially if history's rhythm of fiat expansion continues. While surface indicators, such as interest rate movements or CPI trends, may obscure the picture, the broader undercurrents suggest that gold could be just warming up for a more profound repricing. Could this quiet imbalance between global money supply and real assets be setting the stage for one of the most dramatic revaluations in modern financial history? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.